Shares plummeted 65% in just hours. Hindenburg research struck again, shaking global markets with their latest bombshell report, unveiling significant issues at what was once a $200 billion conglomerate. Their detailed 95-page document presented a staggering 26 separate allegations against the unnamed company, spanning over 5 years of supposed financial misdealings and questionable governance practices. Investors watched in disbelief as the company's stock value evaporated by an astonishing $50 billion within 3 consecutive trading days. The report meticulously detailed 9 alleged fraudulent transactions, indicating a systemic pattern of financial manipulation designed to inflate revenue numbers and obscure actual operational losses. This short-selling firm, a well-known disruptor in the investment world, laid out evidence suggesting that the company's stated profit margins were artificially boosted by as much as 80% in its recent quarterly filings. Before the report hit the market, the shares were trading robustly at $300 per share, attracting strong institutional investment and widespread analyst support, with 12 active buy ratings. However, within a mere 72 hours, the share price had crashed to a dismal $105 per share, leading to an immediate 400% surge in trading volume as panicked investors rushed to offload their holdings. Over 30 major institutional investors, including several large pension funds, began divesting their positions, fearing further downside. The market capitalization loss was not merely a temporary blip. It represented a profound erosion of trust and substantial real-world losses for millions of individual shareholders. 5 separate regulatory bodies across 3 different continents have already announced preliminary investigations into the allegations, confirming the severity and potential widespread impact of the claims. The firm's forensic analysis highlighted instances where key executive personnel sold off shares totaling over $700 million in the 18 months prior to the report's release, a move now viewed with extreme suspicion given the subsequent revelations. The ripple effect was palpable, affecting broader sector confidence, causing a 2.5% dip in the overall market index. This single report, published by a relatively small research entity, triggered one of the largest single-day wealth destructions witnessed in recent financial history, emphasizing the power of independent investigative journalism in holding corporate giants accountable. The fallout is expected to continue for several months as lawsuits mount and further investigations unfold, potentially reshaping how capital markets scrutinize rapidly growing yet opaque companies. Millions of dollars are being spent on legal fees and public relations efforts by the accused company to combat the narrative, but the initial damage appears irreversible. Approximately 5 million retail investors suffered direct financial losses, averaging thousands of dollars each, a devastating blow to personal savings and retirement plans. More than 50 phantom companies were just one part of the scheme. Hindenburg Research's scathing report laid bare a complex web of deceit, involving over a dozen executives manipulating a $200 billion conglomerate's financials. The 95-page document unveiled 26 distinct allegations, focusing on 9 primary instances of outright fraud. Investigators scrutinized evidence suggesting revenue overstatement by 35% for 3 fiscal years, from 2018 to 2021. This inflation relied on shell corporations registered in 3 offshore jurisdictions, like British Virgin Islands, Panama, and Cayman Islands. These entities conducted circular transactions to create fake sales and inflate balance sheets. One allegation highlights $100 million transferred through 5 companies within 48 hours, with no clear business purpose. Auditors from a major international firm signed off on the company's books for over 7 years. They now face immense pressure from regulatory bodies and potential lawsuits. Their review process is questioned because they missed multiple red flags. Hindenburg's forensic analysis pointed to 6 key executive resignations in the last 2 years prior to the report's publication. This exodus links to insider knowledge of impending financial revelations. These executives collectively sold shares worth $700 million, creating massive windfall before public awareness. The report details 4 instances of related party transactions, with entities owned by the chief executive officer's family. These transactions totaled over $200 million, involving assets sold at artificially high prices, benefiting insiders directly. The short-selling firm used publicly available data, whistleblower testimonies, and intricate financial modeling. They found 7 significant discrepancies in inventory valuations across 5 geographic regions, suggesting manufactured assets on books that simply did not exist. A warehouse claimed to hold $30 million in inventory was found nearly empty during an on-site visit by Hindenburg's researchers, a fact corroborated by former employees. The company's internal audit department numbered only 10 people. It was understaffed and lacked independence from senior management, a major governance failure. Whistleblowers, numbering 8 individuals, provided crucial insights into accounting practices. They described a culture of aggressive targets and pressure to meet unrealistic growth projections. These individuals, fearing retribution, spoke anonymously to Hindenburg, providing internal documents, emails, and meeting minutes that corroborated public allegations. Market capitalization loss for the company now surpasses $75 billion over 5 trading days. This erosion affects institutional investors, mutual funds, pension funds, and millions of small retail investors. 1 million employees worldwide face an uncertain future. Stock price remains volatile, hovering around $110 per share, a stark contrast to previous $300. Regulatory bodies in 3 countries, including the United States, the United Kingdom, and Germany, launched concurrent investigations, interviewing dozens of current and former employees. Legal experts estimate potential fines could reach billions of dollars, with executives facing criminal charges for securities fraud. Shareholder class action lawsuits have been filed by over 1,000 institutional and individual investors seeking compensation. The scandal prompts re-evaluation of accounting standards and corporate governance across the entire industry. Another 10 companies in similar high-growth sectors saw stock prices dip by 5%. This is due to heightened investor scrutiny following Hindenburg's exposé. The ripple effect extends to bond markets. The company's bonds were downgraded by 3 major credit rating agencies, increasing borrowing costs. Suppliers demand stricter payment terms, some pulling out of contracts, fearing company viability. Banks providing substantial lines of credit are reviewing their exposure. The scandal is projected to cost the global economy hundreds of millions of dollars in indirect losses and lost investment opportunities for many. A $200 billion empire crumbled spectacularly. Hindenburg research exposed a complex scheme involving over 50 phantom companies. Crucial to this $200 billion conglomerate's manipulation, a dozen executives orchestrated the financial deceit. The 95-page report detailed 26 distinct allegations, focusing on 9 primary outright fraud instances. Investigators found revenue overstatement by 35% for 3 fiscal years from 2018 to 2021. This inflation relied on shell corporations registered in 3 offshore jurisdictions, including British Virgin Islands, Panama, and Cayman Islands. These entities conducted circular transactions to create fake sales and inflate balance sheets. One allegation highlighted $100 million transferred through 5 companies within 48 hours with no clear business purpose. Auditors from a major international firm signed off on the company's books for over 7 years. They now face immense pressure from regulatory bodies and potential lawsuits, as their review process is questioned for missing multiple red flags. Hindenburg's forensic analysis pointed to 6 key executive resignations in the last 2 years prior to the report's publication. This exodus links to insider knowledge of impending financial revelations. These executives collectively sold shares worth $700 million, creating massive windfall before public awareness. The report details 4 instances of related party transactions with entities owned by the chief executive officer's family. These transactions totaled over $200 million, involving assets sold at artificially high prices, benefiting insiders directly. The short-selling firm used publicly available data, whistleblower testimonies, and intricate financial modeling. They found 7 significant discrepancies in inventory valuations across 5 geographic regions, suggesting manufactured assets on books that simply did not exist. A warehouse claimed to hold $30 million in inventory was found nearly empty during an on-site visit by Hindenburg's researchers, a fact corroborated by former employees. The company's internal audit department numbered only 10 people. It was understaffed and lacked independence from senior management, a major governance failure. Whistleblowers, numbering 8 individuals, provided crucial insights into accounting practices. They described a culture of aggressive targets and pressure to meet unrealistic growth projections. These individuals, fearing retribution, spoke anonymously to Hindenburg, providing internal documents, emails, and meeting minutes that corroborated public allegations. Market capitalization loss for the company now surpasses $75 billion over 5 trading days. This erosion affects institutional investors, mutual funds, pension funds, and millions of small retail investors. 1 million employees worldwide face an uncertain future. Stock price remains volatile, hovering around $110 per share, a stark contrast to previous $300. Regulatory bodies in 3 countries, including the United States, the United Kingdom, and Germany, launched concurrent investigations, interviewing dozens of current and former employees. Legal experts estimate potential fines could reach billions of dollars, with executives facing criminal charges for securities fraud. Shareholder class action lawsuits have been filed by over 1,000 institutional and individual investors seeking compensation. The scandal prompts re-evaluation of accounting standards and corporate governance across the entire industry. Another 10 companies in similar high-growth sectors saw stock prices dip by 5%. This is due to heightened investor scrutiny following Hindenburg's exposé. The ripple effect extends to bond markets. The company's bonds were downgraded by 3 major credit rating agencies, increasing borrowing costs. Suppliers demand stricter payment terms, some pulling out of contracts fearing company viability. Banks, providing substantial lines of credit, are reviewing their exposure. The scandal is projected to cost the global economy hundreds of millions of dollars in indirect losses and lost investment opportunities for many.